China is promising retaliation now that President Trump has made good on his promise to raise tariffs against the country.
The administration raised tariffs on $200 billion of Chinese imports from 10% to 25%. At the same time, talks between the U.S. and China continue.
The president isn't backing down. He tweeted a short time ago, quote, "We have lost $500 billion a year for many years on crazy trade with China. No more."
Yahoo Finance's Jessica Smith in our D.C. bureau live this morning. Jessica, where do things stand at the moment?
Well, talks will pick up again this morning at the U.S. Trade Rep's office. Ambassador Lighthizer and Secretary Mnuchin met with the president last night after talking with the Chinese delegation, having dinner with them. They met with the president and they decided to go ahead with this tariff hike. Now, the president has been on Twitter this morning talking about the China trade situation. He's been talking how he thinks tariffs will be good for the country, and he says there's absolutely no rush on talks with China. He says tariffs will bring in far more wealth to our country than even a phenomenal deal of the traditional kind, also much easier and quicker to do. He went on to say that the U.S. has started the process of putting 25% tariffs on the remaining Chinese goods. And he floated another idea that we haven't really heard before that would address one of the big concerns in this situation, which is the impact on U.S. farmers. The president says he wants to take the money that comes in from tariffs and use it to buy agricultural products from U.S. farmers and then ship it to countries that need it all over the world. So the president is saying that it would be a win-win here, but he is ignoring what economists and lawmakers in his own party say, that it's U.S. consumers and U.S. businesses that pay for these tariffs. He seems insistent on the fact that the Chinese are paying for the tariffs. And we should note the tariffs that went up overnight, they have a little bit of wiggle room here. Goods that are actually on the water right now are not included in that, so businesses have a little leeway.
Yeah, Jess, I'm really getting ready for the Friday evening news dump on the trade front, but what are the chances that Vice Premier and President Trump get to meet?
Well, there's nothing on the books at this point. They did meet last time they were in D.C. in the Oval Office. They brought cameras in for it, but nothing on the books at this point. The president did say he got a letter from President Xi yesterday, and he said they might talk on the phone at some point. It's unclear if that has happened just yet.
All right, Jessica Smith, live in D.C. Thank you. You know, it's interesting. President Trump tweeted earlier this morning, there is, quote, no rush to come up with a deal with China. And we saw stock futures tank on that news. And if you look back at his Twitter feed now, he has since deleted that tweet. Oh. But I guess the thinking there is, if this is a prolonged situation, at some point it's going to hit American companies' bottom lines, and we as consumers will have to spend more.
And this is the same discussion we came in with talking about on Monday, and this is how the week is going to end. It is a big deal. The market has been very, very volatile this week, and that is despite corporate America continuing to report very strong earnings reports. You know, yesterday I talked to Tapestry CEO Victor Luis. He tells me that the company has been actively moving supplies or their supplier base out of China to the point so they can just better manage their business. But he said they might have to raise prices. That's the reality.
Yeah, but you know, the fact that they're at least talking right now is a good sign. It means probably companies will hold off raising prices in the hopes that a deal can happen sooner rather than later.
But it won't be a perfect deal.
No, that's for sure. No. All right.
Let's keep this moving with Ed Mills, Washington policy analyst at Raymond James. He's in Yahoo Finance's D.C. bureau this morning. Ed, how bad could this get?
Bad. What we have right now is that, the tariffs are in place. Talks do continue. But I think you really have to take a look at this and saying the hope that we get a large-scale deal that kind of really deals with intellectual property theft, tech transfers, subsidies for state-owned enterprises, the top three concerns of the Trump administration, might be off the table. Right now, we have China, who does not think that the Trump administration is all that bold in their resolve. They think that any stock market correction or any economic weakness is going to see Trump play, kind of defense once again, repeat what he did in January. And ultimately, I don't think Trump is willing to sign a deal unless China makes large-scale reforms, which they just don't want to do.
And if they're not going to do that, Ed, and Trump is really, in essence, forced to sign this deal because of the way the economy is going to go, the way investors are going to react, if that deal doesn't check those boxes that you just outlined, including the issues of intellectual property and access to Chinese markets, does it look like Trump has failed here, and does that hurt his chances in 2020?
Well, I think the base case here actually is that he keeps on fighting through the 2020 election. It is actually a lot easier to be fighting China and having the trade fight than defending a weak deal. I think that kind of many voters look at this and don't know all the nuance. And if he can be out there fighting on behalf of American manufacturers, that looks good politically, and that kind of favors him in the states that he needs to win in 2020, which is that industrial Midwest. So I would look more towards a fight continuing rather than him trying to defend a weak deal.
You know, and when I hear you say this can get bad, I immediately think the markets are still around records. It could also get bad for investors. What could the pullback look like for the markets?
Yeah, so I think the debate here is that the S&P 500 has been trading at a premium multiple, given kind of the strong economic backdrop, given the kind of pullback in tightening from the Fed. So as I talk to kind of some of our equity strategists at Raymond James, what they say is you might want to put more of a traditional market multiple of 15 times earnings. And that would kind of have a decent pullback from here. The question is that what are earnings going forward? If these tariffs remain for a considerable period of time, that might shave a little bit off of GDP growth. That would kind of impact kind of margins, which would impact earnings. And so 15 times a lower earnings multiple would be that next leg down. Ultimately, I think where investors are still betting is that if we are in that conversation where there is an economic deterioration, the Fed comes to the rescue. Mm-hmm. And those debates on whether or not the Fed is going to cut increase as any China kind of showdown goes on.